This video was brought to you by Ground News. For most of its recent history, the People's Bank of China has deliberately devalued its currency, the yuan, to keep Chinese exports competitive and stimulate China's manufacturing sector. However, in the past few months, thanks to a divergence in interest rates and China's general economic woes, the yuan has declined further than the PBOC would apparently like, with another steep decline coming on Monday. So in this video, we're going to take a look at how the PBOC controls the yuan, why it's declining, and why this is moderately bad news for the CCP. Before we start, if you haven't already, please consider subscribing and ringing the bell to stay in the loop and be notified when we release new videos. So, before we get into the most recent news, a quick history of the yuan. Before basically the 80s, the yuan was actually overvalued. Like many other developing countries at the time, the Chinese government set its value at a fixed exchange rate with the dollar, but they set it higher than it should be because they thought that it would be good for their purchasing power. That's because by pegging the yuan's fixed exchange rate higher than it already should have been, China allowed themselves to buy more stuff. However, in the 80s, when China was struggling to enforce its capital controls and the yuan was already coming under pressure, they started to slowly devalue their currency. Now, it was still a fixed exchange rate, but the number of yuan to the dollar slowly started increasing, from 1.6 yuan per dollar in 1980 to 5.8 in 1993. Then, in 1994, the People's Bank of China suddenly devalued the yuan by a third, from 5.8 yuan to the dollar to 8.7. This basically took the yuan from being overvalued to being dramatically undervalued. And this is a major reason why China went from having a trade deficit in the 80s and early 90s to an increasingly large trade surplus by the 2000s. Basically, in the 80s and 90s, when the currency was overvalued, China was buying more stuff than it was selling. But by the late 90s and 2000s, this had flipped. China's currency was now undervalued, which meant that Chinese manufactured goods were excessively cheap to the rest of the world. So China ended up selling more than it bought. By 1995, a new peg had been established at 8.3 yuan to the dollar. And this exchange rate will be rigidly maintained until the middle of 2005. If the yuan wasn't already undervalued, after a decade of fixed exchange rate, it definitely was. And that's because between 1995 and 2005, China experienced rapid economic growth. And while foreigners were encouraged to invest in China, ordinary Chinese were effectively unable to get their money out of the country. These two factors would usually push up the value of your currency, but China decided that an undervalued currency was actually good for their economy because it helped China's exports. By maintaining the peg at 8.3 yuan per dollar, China effectively further devalued its currency by another 20% between 95 and 05, according to estimates by the Bank of International Settlements. Now, China finally allowed its currency to slip a bit in 2005, when it moved from a fixed peg to what's known as a managed float, which allowed the yuan to move within a narrow band. Every morning at 9:15 Beijing time, the PBOC would set a so-called reference rate, and the yuan would be allowed to trade within a couple of percentage points either side of that rate. Now, initially, China allowed the yuan to trade within 0.3% of the reference rate in 2006, widening to 0.5% in May 2006, 1% in April of 2012, and 2% by March of 2014. And this new managed rate allowed the PBOC a degree of flexibility while also allowing them to keep China's currency under value, which keeps China's exports super competitive. However, in recent months, the yuan has begun to decline sharply against the dollar. And this time, it doesn't look like the PBOC actually wants it to. The yuan has declined from 6.7 yuan per dollar at the beginning of this year to 7.2 per dollar today. And the latest slip came only on Monday, when the yuan fell by another 0.6%. Now, that might not sound all that dramatic, but it's pretty significant when you consider quite how widely traded the yuan is, and the fact that its exchange rate is actively managed by the PBOC. It's also the lowest the currency has been since basically 2008, excluding a brief spike late last year when China was still in lockdown. So why is this? Well, there are basically two reasons. The first is China's general economic woes. Now, we've done a whole video on this before, so go and watch that if you want to know more. But the TLDR is that, at the beginning of this year, it looked like the Chinese economy was roaring back to life post-pandemic. The property market saw a promising uptick in home sales, and Chinese exports surged in March, despite weak global demand. In fact, according to official statistics, China's economy grew by 4.5% year-on-year in the first quarter of this year, well above analysts' expectations. And not only that, but China looked on track to reach the CCP's 5% growth target for the year. However, data released earlier this month for the month of May suggests that things aren't going quite so great anymore. Relative to earlier this year, Chinese consumers are spending less, Chinese factories are producing less, and China's debt-ridden property market, which accounts for something like 30% of all of China's economic activity, is looking at another slowdown. This slowdown has exacerbated China's youth unemployment crisis. And by May, China's urban youth unemployment rate hit 20.8%, the highest since records began in 2018. All of this combined has sparked a sell-off of the yuan, which has been exacerbated by the weak performance of China's exports, which are down 7.5% year-on-year. It's not just the general economic malaise, though. Another reason we're seeing this issue is interest rates. Essentially, when a country raises interest rates, it usually strengthens its economy because it becomes more attractive to save money in that currency, which increases demand. This is why, as the US Federal Reserve hiked rates in America, the dollar has strengthened. Conversely, because China isn't seeing inflation thanks to weak domestic demand, the PBOC hasn't been hiking rates. And early this month, they actually cut rates in order to stimulate demand. And this divergence, higher interest rates in the US and lower rates in China, helps explain why the yuan has declined quite so quickly against the dollar recently. Now, usually, this wouldn't be all that bad, because as we mentioned before, a cheap yuan keeps China's exports competitive. However, as we explained in previous videos, the CCP are currently trying to rebalance the Chinese economy away from international exports towards a more sustainable economic model driven by domestic consumption. And the problem is that a weak yuan will undermine ordinary Chinese citizens' purchasing power, reducing consumption, while also encouraging more exports. A weak yuan could also exacerbate China's accelerating debt crisis, especially in the property sector, where many property developers have taken out dollar-denominated loans, which will be more difficult to pay now that dollars are more expensive. All in all, while it's not fatal, the weakening yuan is a symptom of investors' waning confidence in the Chinese economy, and it almost certainly will undermine the CCP's efforts to rebalance the Chinese economy. Now, we don't really know how China will respond to this, because as so often with these stories, the answers are complex and nuanced. As such, our goal has always been to shed a light on these stories so that you can better understand what's going on in the world around you. Unfortunately though, many news outlets use this complexity and nuance to frame a story in a certain way. Which is why I'm so excited to tell you about today's sponsor, Ground News. Ground News is a very useful website and app which I use every day, and that lets you compare related articles all in one place from thousands of news sources around the world and across the political spectrum, with context about the source of each piece of information. For instance, take this story about more Chinese balloons being found over Asia. Ground News allows me to see which outlets are reporting on this most. In this case, a majority of the articles come from right-leaning outlets. It also allows me to compare headlines and stories by outlet, giving me the opportunity to get a fuller picture of what's really happening. And if I want to dive deeper into any of these reports, I can be taken there with just one tap. with Ground also providing reporting accuracy and bias scores for each outlet. Now, I have Ground on my phone's home screen, and I genuinely can't recommend them enough. And because of this, we've decided to offer a special 30% discount on Ground News's Vantage subscription. And you can only access that discount by clicking the link below. So be sure to check it out and help support an independent news platform working to make the media landscape more transparent.